Today, we're breaking down a powerful and pretty risky economic force, hot money.
Sounds wild, right? But it happens. And it's all because of this thing called hot money.
All right, let's get right into it. What exactly is this stuff?
Think of it as money that's always on the move, chasing the fastest profits anywhere on the globe.
And the key word here is speed. These investors want in and out fast with a quick profit.
So, what happens when all this cash floods a country? Well, it's a real double-edged sword.
When the money pours in, it can feel like a party. Markets boom. But when it leaves, a crisis. And that sudden exit, it's called capital flight. What comes in fast can leave even faster.
So you have to wonder, how do countries protect themselves from this kind of volatility?
Places like Brazil and Thailand have tried things like this, basically to slow the money down.
Now, this isn't just theory. It's had a massive impact right here in India.
Let's just rewind to January 2011. It's a perfect and pretty painful example of what can happen. That's how much money foreign investors pulled out of Indian stocks in just 1 month. That sudden withdrawal sent shockwaves through the market, and local investors, they were hit the hardest. And it's no secret. Experts have warned for years that relying on this type of investment is really risky. So that's the billion-dollar question, isn't it? Is all that risk worth the shot at rapid growth?